Fiserv stock is down 47% in the past 5 days. The stock is trading at $65 at the time of this recording with a market cap of $35 billion. Its PE ratio is at 10 currently, but the forward PE is at 8. So is this too cheap to ignore? Is this a potential 3x opportunity? This is what I'm going to cover in this video. Please note this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts about Fiserv. In full disclosure, I do not own any shares or options of Fiserv at the time of this recording. Now, let us look at why the stock is down. They reported earnings and it was a big miss on EPS and miss on revenue. In addition, they cut guidance. Full year EPS guidance slashed from $10.30 to $8.60. Now, organic revenue growth forecast reduced from 10% to about 4%. The management has given reasons on why this is the case. Now, they're saying slowing growth in the Clover payments platform, which is a key business unit. The other reason is concerning, as it involves fraud allegations. The CEO hinted that the previous management has done something with the numbers, including inflated growth figures. This sounds really concerning, as there may be an issue with the numbers they're showing. There is also a class action lawsuit against them. Now, it seems that their CEO is pragmatic. CEO acknowledged underperformance, new co-presidents and CFO appointed. They also have an action plan to reset the strategy and improve execution. Let me now give you a quick glimpse of their business model. Fiserv is a global fintech and payments company. They have 3 core businesses segments. They make money via transaction and subscription-based fees, software licensing, and professional services. All these are decent margin businesses. Let us now look at their revenue and margins. Now, they are a big company with almost 21 billion in revenue. Growth has slowed to single-digit percentages. Operating margin is at close to 30%, which indicates good and matured business. One thing to be concerned about is their debt. They have 28 billion in debt, but we know they are a 35 billion market cap company. This seems bad, but we need to look at what kind of debt is it. Not all debt is bad. So they have senior notes and lease obligations, which are typically added to that debt. This is not bad. This debt also includes some accounts receivable, which are amounts owed to the company. Since they are a financial institutions, there are other types of entities included in this debt that could be not bad. So overall, they have heavy debt, but it's not super concerning. But we will keep an eye on this number in the coming quarters. Before I move on to the valuation, I want to talk about the outstanding shares. Now, they had 683 million shares in 2020. Now they have 558 million shares, which means they are buying back a lot of stocks, which is good for the investor because they're buying back a lot of stock. Finally, I will talk about the valuation, but before, I'm just going to ask if you can smash that like button, subscribe to the channel, and let's continue growing together. Now, for the valuation, I am assuming they can get to $10 EPS in the coming 2-3 years. Please note they are making $8 EPS already this year. So $10 is achievable in my opinion. I am assigning a multiple of 20, which they deserve after the management regains trust of investors. They need to implement their plan to come out of this mess and get the company back on track. Now, the new CEO came out with numbers and publicly accepted that there is an issue with the company. Also, let's keep in mind the new CEO always sandbags numbers as they want to comfortably beat the targets to show their execution. Now, this is not always the case, but something we can just keep in mind. Since they are known for buybacks, I am assuming they can get to 500 million shares in the coming years from the current 558 million. This gives me a price target of $200, which is a 3x from the current price of $65. Now, this is attractive, and I think it is a good risk reward in my opinion. But let me make this clear, there are risks. Short term, the stock can go even lower due to legal issues, leadership shakeup, and credibility concerns. Long term, the potential upside is massive if management regains trust and gets the company back on track. In any case, I would not make this more than 3% of my portfolio. I think it is not a bad idea to buy all at once as the price of $65 is attractive. Now, on the other hand, I may buy slow and dollar cost average until I get to the 3% allocation. Let me know what you think. Let me know your thoughts in the comments, and thank you so much for watching.